Okay, so Anthea, for those that are not familiar with Wesdomes, perhaps you could give a little bit of an introduction, market cap, size of portfolio, and other information.
Sure. Wesdome is an interesting little company, a very simple, compelling company that has got a roadmap ahead of it that's quite exciting. You know, we've got all the boxes ticked for a really good mid-cap investment opportunity. Firstly, being we're in the jurisdiction that makes sense in Canada. We have got 2 high-grade mines. We have a balance sheet that's extremely strong. And we have an opportunity in terms of that organic profile that allows us to continue to grow it. We have 2 mines, one in Kiena, which is our Kiena mine, which is in Quebec, in the prolific Abitibi gold region. And we have the other mine that lies in Ontario, which is in Wawa, which is our Eagle River mine, which is on the Mitsubishi Greenstone Belt. These mines have been in production for, I would say, around about 20, 30 years, and they've produced about 4 million ounces of gold. And in that lies a lot of experience and a lot of depth in what this is. So I think from a potential perspective, the business is about a $2.5 billion company at this stage, with significant upside potential to continue to grow, and with a team that knows how to grow it.
Okay. Thank you for that overview. What do you think it is that sets Wesdome apart from its peers in the sector?
You know, Wesdome is interesting because we've taken a very disciplined approach towards shareholder dilution over the time. And I think over the period done two actual raises whilst we built a mine. And we've seen, you know, significant growth in our production year on year. We've doubled our production every 5 to 6 years organically, as well as at the same time ensure that our free cash flow continued to grow about 10 times over the same period. So a really interesting little company with significant growth. With that, we also made sure we actually kept increasing our reserves and building our reserve base. So what you're seeing Wesdome doing is not only getting record production rates that continues to grow, but you're also seeing a reserve base that continues to be replaced. You know, on a per share metric basis, which is something we worry about, our company is, we all know we work for shareholders. We believe this company delivers strongly on shareholder metrics. And on any shareholder metric that matters today, I believe Wesdome sets itself apart from its peers, as well as some of the larger caps as well. Whether this be jurisdiction, whether this be cash flow, whether this be any of those, Wesdome is very strong in most of these things. And it's within that base that we're going to see ourselves continue to grow this organization.
Okay, that's great. And certainly Wesdome's been around for a long time. These mines have delivered quite a bit. But now you have this 3-pronged organic growth strategy. So perhaps you could share with us what that involves and what it means for production and costs going forward.
Okay. I mean, what we've done really well, I believe, is we continue to grow and add value over the time. And I think our organic strategy, which is really simple, is around filling our mills. You know, we have 2 mills that are actually running at a very a low capacity comparative to their permitted capacity. So the aim of the fill the mill strategy is to move from between 30 and 50% of our current installed capacity up to 80% capacity. Now you'll ask yourself, why? Why are we there? The reality is that this company was originally built on a different grade profile. They were running up at the upper ends of the mine at a lower grade and higher tonnage. You know, we fast forward, 2 decades later, and we've got 2 very high grade mines and a lower utilization of the mills. So the strategy we have is really about filling those mills, and it's got 3 prongs to it. The first prong, 2 of the first prongs being production driven and 1 being cost driven. The first production driven driver is really around our growth model, which we call our global model strategy. And in this, the global model was intended to have a look at this mine a little bit differently, to stand back from this operation and to take what we have in the operation and to leverage it, to move away from just driving the high grade and to add on incremental opportunities that existed in the mine, either parallel or in the upper sections of the mine, to leverage different strategies to drive that. So the global model work, we started about 15 months ago, where we took data from the mines that were never digitized, and we were able to put it into a digital format to tell us exactly what this mine looked like. And with this, we found a lot of opportunities and potential which we could leverage for the operation itself. Whether they be at a different grade, it doesn't matter. It's all about value. So the organization says, well, if we can find a valuable ounce or valuable ton that's lying nearer to surface that could incrementally add to a higher grade ton that's coming from the lower sections of the mine, we should be able to drive more value because this mine is a low tonnage, high grade operation. So we like to leverage fixed cost. So that's the first driver. The second driver really is around exploration. And exploration in Wesdome has been the cornerstone of the success of this company for the last 30 years. We've been able to find discoveries year over year, and we continue to find it. It's a highly prospective ore body that's got great potential to try and drive more. So we spent time last year on really changing the strategy to drive more of an aggressive exploration approach. And this exploration approach is aimed to drive the fill the mill strategy as well. Okay, so that's the second pillar. The third pillar is around cost. And I think the cost profile is really important too for us because we saw with a high-grade mine, you see a cost profile moving in a direction. It's nice because grade sometimes can hide problems. We've gone back and said, let's turn this around. Let's figure out the cost profile to drive more value. And we're making great success on this. We look at this calculation from both a denominator and a numerator effect. The denominator being, well, if you can leverage more tons that are valuable into the mill, you can leverage your fixed cost, which is a quite significant proportion of our current cost base. And the second thing we wanted to do was look at the numerator, which is really around a couple of drivers, productivity and cost being the largest ones of those. The productivity driver impacts production as well, which is helpful. And obviously on the cost side, we were able to leverage some of those benefits in some of the work we're doing. So we're already seeing on that side progress made on both supply chain benefits, maintenance opportunities. We've seen some simple ones coming through, which are driving, quick hits in terms of cost optimization. And we start to see the roadmap turn on this side, which is allowing us to look at cut-off grade differently and allowing us to unlock further resource and reserve in different sections of the mine.
Okay, great. Thanks for that. Looking across my own coverage universe, you're one of few companies that has production growth. And you certainly delivered that last year. I think growth was up 40% year over year on a consolidated basis, looking at both mines. But again, looking at the guidance this year, production is set to grow another 16% and maybe even beyond into 2026. So could you discuss the outlook for 2025 and what the drivers are for growth and beyond that into 2026?
Sure. Yeah, we pride ourselves on organic growth at Wesdome. So, and we'll see double-digit growth again this year. We did 40% last year. We'll see it continue to grow. A lot of this is driven, again, by the strategy of really getting down to doing things the right way. So in Eagle River, last year we spent the time on really unlocking more mining areas nearer to surface, as well as ensuring that we deliver well on what we were doing. So you're seeing Eagle River consistently deliver to that plan. In Kena was brought into production again in April last year. So we had 3 quarters of the higher grade material coming through. So this year you'll see 4 quarters of the higher grade material, plus the first start of the fill the mill strategy happening in Kena, which is the addition of the Presqu'île resource, which brings about 10,000 ounces across to that. So those are the 2 major drivers of production. But then the cost driver is important as well. What we're seeing on the cost side is the widening of the jaws. I always tell my team, you want to widen these jaws to make yourself very resilient to gold price. I've been around the block too long to know that commodity prices move. So we want to make sure that we keep our resilience the whole time, get that cost down, and unlock further potential as well. So it's a large focus on just delivery and execution, as well as a delivery on making sure we prepare ourselves strongly for the future.
Okay, and certainly evidence of that delivery and the high grades at Kena is your balance sheet. I mean, you're now debt-free. The balance sheet, cash balance is growing quarter over quarter. But maybe it's time to start talking about capital allocation. So what are you and your board thinking about in terms of returning value to shareholders?
Yeah, so we have a good balance sheet, and I think we continue to see this position continue to grow thanks to the production increases we're seeing, as well as gold price moving in the direction that's always nice. So capital allocation discussions, you can just imagine, are very, very exciting in our offices at the moment and very much a part of the conversations. One of the most interesting things about Wesdome is that the best return on shareholder value to date has been really in the drill bit and in what we can do in our organic opportunities in the mine. So we believe focus on that is critical. So we've spent some time revisiting and making sure that whatever we can do to drive value organically, we should be doing. And whatever we can do to maximize on that, we're going to continue to do. And with the gold price continuing to increase the way it is, it's obviously our budgets have been shooting out on that side, allowing us more potential to look at this in the right kind of way. So When you look at our capital allocation or capital itself internally, we're spending $160 million this year, self-funded on capital. The first part really being on exploration of about $40 million. We're spending $40 million on actually developing and unlocking the Kiena mine to allow us to do more and to grow that mine more. And the third part is really on development, which is the biggest proportion of that mine. So capital has been spent in the right kind of way, and we're going to continue to understand where we can find good uses of capital to drive more value. That's the first side. The other side is, despite that, there is going to be a lot of cash in this business. So these options are well being looked after or looked at the moment. I have a new chairman starting in a short while, and I think we'll have these discussions with him when he comes internally and understand what we need to do to be consistent on this side as well.
Great. So when we look at your guidance for this year, looking ahead to next year, with respect to the outlook, I mean, one of the things you talked about was the fill the mill opportunity, and that's actually at both assets. So in those numbers that you've released, does that account for the opportunity to fill the mill? And if not, what is the incremental benefit, or how do you see that playing out over the next couple of years?
So our current plans include the reserve. So if you look at what we have, we use the current reserve, which doesn't include the full mill work. We're busy working on finishing that this year. So this year's work on the global model side is around creating an unconstrained model, doing confirmation drilling and QA and QC, and making sure we get the mining studies complete. So that work's in place, although it has some influence a little bit on the future as well. So if you look at the two mines, Kiena itself is already seeing some portions of this, in that we were able to take on Presqu'île this year, and we'll continue to grow Presqu'île into next year. So at the end of this year, we bring in the first bit of Presqu'île, which is in the upper sections of the mine. It's actually probably about 100 meters, 200 meters below surface. And then we put out a reserve resource just recently, where we show that Dubuisson has now been converted into a reserve. So hopefully we can work on a mine plan for that and get that into the plan for 26, 27 as well. That gets the second source of ore from that side. And that's without the global model work that we probably would look at some stage. So Kiena's fill the mill strategy is slowly moving incrementally in that direction. It doesn't take away 1 ton, high-grade ton from Kiena Deeps. So Kiena Deep consistently delivers, and we add on these sections that are lying in the upper sections of the mine. In Eagle, it's no different. Eagle River has got a very significant 300 zone, which sits between 20 and 25 grams a ton in reserve grade. It's a very high-grade area. And what we're looking there is the parallel zones nearer to surface, how we can leverage those. So we're leveraging the Falcon zone, we're leveraging some of the 6 Central zone and other zones that we've actually found, funny enough, through the global model work as well, and starting to unlock those potentials. So that's the one side. The other side I think is important to note is what Wesdome does is we take a conservative approach on reserve pricing for gold. So we look at about 1,500 gold pricing. But what we do is we make sure in the year basis we consider opportunities to create value through the gold price as well. So if there's opportunities near mine that we can leverage to drive further value, that will also come into the plan. And we saw a little bit of that last year at Eagle specifically, and I think you've seen Eagle already starting to do it again now. So overall, the grade might go down slightly, but the value of the business will go significantly up. And I think it's important to say again, in a high-grade, low-tonnage mine, your fixed cost percentage is very, very high. So what you want to do is drive that mill as much as you can, especially a mill that already works.
Okay. Well, certainly, Wesdome checks a lot of boxes for investors, and you've been alluding to many of them: jurisdiction and exploration, upside, the balance sheet. But one of the pushbacks that investors bring up sometimes is the length of the mine lives. And so how do you address that shareholder concern? What is the mine life, and how do you address that?
We hear this all the time, and it's one of those things that irks me slightly, to be honest with you, because it's something that Wesdome's always had. Wesdome has always had between 3 and 5 years of mine life ahead of it. It's an underground, high-grade, narrow vein mine. So what Wesdome did historically was they followed this particular ore, and they applied this approach from the beginning, and then continued to keep building out these 3 to 5 years ahead of themselves, and have done that for 30 years. For 30 years, Wesdome has always had this kind of mine life. There's a subtlety in this too that's important. When you in a high-grade underground mine, You want to balance your capital efficiency and your drilling efficiency very carefully on reserve replacement as well as your capital utilization. So you want to balance this very, very carefully. Otherwise, you can blow out the capital for reserve, but actually have another problem. So this is the balance that we continue to have every day in Wesdome. But we're aware of this, and we know it's an opportunity, and we have a plan now to further grow out the mine life itself, as well as to fill our mills. And that's through these two very big sections which I've spoken about, which is first of all exploration. We have increased the budget quite substantially to drive how do we get exploration to keep building out this plan. And similarly on the global model work, it's going to help us understand how we can leverage existing infrastructure to drive that mill as well.
Okay, that's great. I'm going to do a brief time check. I think we've got 3 minutes left. I've got more questions, but if there's any from the audience that we're pressing. No, well, with that, you've got a new head of exploration. You've got a $40 million budget this year. What can investors expect as they execute on that?
Yeah, I mean, Jono's started with us in January. He's a really great guy, great experience. I'm excited about what he's going to do. But if you look at his two mines, he's been given quite a sweet mining company. He's got, on the one mine, on Eagle River, we have at least 20 areas which we know about right now, and we have a handful of those that are lying in the current plan. So he's going to be looking at unlocking those, understanding areas which have previously been looked at but left alone, and we're going to go back and we're going to go investigate them and pull those in. So that's the one side on Eagle. On Kena, we have 23 zones in Kena, of which only 3 are in the current reserve. So we'll be mining in Kena for years to come. The focus at Kena has been on just focusing on the southern corridor of the operation. There's the northern corridor that's completely open, that's untouched. So I think he's going to be extremely busy.
Okay, great. So you spoke about production growth at both of the assets. Do you feel, with respect to M&A, there might be a need to further supplement that growth? What might that look like?
I think from an M&A perspective, I think you can see how precious these mines are. And when I look at these mines, I'm constantly saying whatever we need to do has got to be accretive to our shareholders. Whatever we do has got to add value. So it's quite hard when you have really precious mines to find something that simply adds value this way. So, but are we open to M&A? Absolutely. We keep looking at it. We keep very prudent. But it's got to meet the criteria that delivers on shareholder value. I don't need to grow to grow. I need to grow to add value to my shareholders.
Okay, and with that, maybe we'll wrap up with just a reflection. 2024 has been your first full year in the seat as the CEO. So reflecting back, can you discuss and share with us the changes that you made and how they've gone, and maybe looking ahead what changes are to come?
Yeah, I mean, I think the first change that I made was really focusing the business again to value. I mean, I think we were a high-grade mine that continued to deliver on ounces, but I wanted to get the company to understand that everything you do should add value. I mean, I think getting that focus alongside making sure that risk is managed in the best possible way. How do we understand risk in this company? How do we plan to make sure when we do things, we're always doing it right? You know, I say to my team the whole time that we're custodians of the ore body for our shareholders. So whatever we do, we need to protect this ore body as best possible, extract it in the best possible way. So that's been a strong focus on ESG, as well as in my pet project, or my pet thing is around safety, getting the teams realigned to those values, making sure they work really well. I mean, those are amongst the things we've done. And obviously you've heard me speak about exploration, which was a reshape completely in exploration to be more aggressive on that side. And if we look forward now at Wesdome, I think Wesdome, has a lot more clarity around being more long-term than it was before. We have a very good vision now of what we need to do now, today, and what we need to do medium to long-term. And I think the team is fully aligned on what they need to get right by when. I don't measure them on the short-term alone. Short-term is important to get right on guidance, but long-term is what's going to drive real value and real growth. So we have more clarity in this team, and I think the team is fully aligned to what we need to do. But since I've been here, I think the thing is, it didn't change. I came into Wesdome and did a lot of work before I came in, and I tried to understand this company, and I was excited then. When I walked into the organization, saw plenty of opportunities. The vision really hasn't changed. The only thing that's changed is it's much better than I thought. There's so much more to this company than I even could have imagined, and it's now going to be about how we keep doing the right things to push this company in the right direction. The future is bright, let me tell you that much.
Okay, and the share price has certainly been up quite a bit since you joined. Thank you very much, Anthea.